What are you expecting to see this week when we kick off first quarter earnings? We should note that the first quarter will not have the easy comparisons that the rest of the year will have, as the economy really shut down in mid-March in 2020.
I think earnings will be, it's going to be variable by company, obviously, but when you take United Health as an example, I think they actually will have some, they'll probably have pretty good earnings. The banks are going to have, I think, pretty strong earnings as well. We do have somewhat higher interest rates helping the banks. But I think, on balance, I think the markets look well beyond this. I think Wall Street has gone through a nice recovery here, as we all know. As you spoke earlier, all the stock indexes are now at record levels. I think what's interesting is now Main Street is going to come back. And I think that's very, very, very important for the economy broadly. I think jobs are coming back. The economy is coming back. GDP in this country should be 6.5% to 7% growth over last year, could be higher. Rest of the world is much more troubled. The recovery is slower in the emerging markets in particular. But I think earnings should be good. But I don't think the stock market's positioned to go a lot higher. We've had a very long period of frothy excess here, GameStop being kind of the poster child for that sort of thing. We've had high options activity. Some of that's starting to unwind a little bit. I think this melt-up is continuing on the one hand, but I don't think the earnings season is going to help in terms of driving the stock market to higher level. I think there's going to be a period of retrenchment here and a period of, I'm from Missouri, show me, to use that term.
Yeah, I mean, because there's been a lot of the easy money made, I guess, is what you're saying. And you said you called it a melt-up as well. Nancy Lazar is calling it a melt-up. What does that mean in terms of allocating capital for you right now, Fred?
Well, it means that we're still long cash to a much greater extent than we usually are. We're not fully invested. Right now, we're about 25% or 24% cash. During most of 2020, we were 35% cash to 40% cash, which was excessive and hurt our performance relative to what it would have been, but it was still exceptionally good, I'm glad to say, because of specific stock selection. But I think right now we're cautious. We actually think the next 2 to 3 weeks will be tricky. And we're prepared to put money back into the market upon a rollover. We think there will be a rollover. I think there's also danger in the debt markets. This debt bubble is deflating. Higher interest rates are in the offing. The fact that the 10-year is at 1.66 is not alarming, because 1.66 is, relatively speaking, a pretty low rate. And we know the Fed is going to remain dovish. Powell has been very clear on that. I think the stock market is relying on that. And I think any messaging to the contrary is going to create a real rollover in the market, a meltdown, as it were, or a temper tantrum, as people like to use that term. So I think we're relying on the Fed to support this stock market.
All right, so you want to sit tight for a little while until you have better prices, it sounds like. Federal Reserve Chairman Jay Powell was on 60 Minutes. He told 60 Minutes yesterday that the U.S. economy is, quote, at an inflection point, but some risks still remain. Here's a soundbite of Powell on 60 Minutes. Watch this.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of, widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
Fred, does that coincide with valuations, or yeah, we could be at an inflection point, but that doesn't tell me to invest in this market because valuations have predicted this and been ahead of that notion? What do you think?
I think it's the latter. I think the market has already fully discounted that. Yes, I think Main Street's going to have a boom time over the next 2 or 3 quarters. I certainly hope so. I want to see restaurants thrive. I want to see the local retailer thrive. I want to see local economies who've been so hurt, and individuals who have been so hurt come back strongly. The consumer has money. He will spend that money. I think one of the risks to this economy, however, And it's really more a risk to the capital markets, are, in the short term at least, is higher taxes. I think the $2.3 trillion infrastructure bill, which is a misnomer, because in point of actual fact, half of it or so, it might be categorizable as physical infrastructure. A lot of it is social spending. Free community college is not, in my view, infrastructure. Nor is rolling back right to work laws in various states infrastructure. But putting all of that aside, this may be a preview of what we're going to see from this administration going forward. I don't think that's positive for business. I think capital investment will be somewhat restrained, and employee hiring will be somewhat constrained in the face of higher taxes. I think this is not a good time to increase taxes. If you want to increase tax revenues, by the way, maintain taxes where they are. In fact, you might even drop taxes. That won't happen, I know. But, you know, his history tells us that reducing taxes is stimulus to the economy, and that would be a very positive thing. But we're not going to have that. I worry about higher taxes.
I hear you. Larry Lindsay from the Lindsay Group calls it 15% infrastructure, 85% other things like social spending. Fred, you're spot on that. But they're going to be trying to sell that today. Kamala Harris and Joe Biden will be talking with Republicans and Democrats, trying to sell that quote unquote infrastructure plan, which is obviously a spending plan. Fred, it's great to see you this morning. Thank you so much. We will be watching all of the above, and we'll talk soon. Thank you, sir.